Now let's talk about exchange fees, an important part of every trade. In this section, we'll explain taker fees, maker fees, and liquidation fees, and why they matter for your overall trading results. Every crypto exchange charges small fees whenever you open or close a trade, and sometimes when your position is liquidated. Even a small fee like 0.05% can quietly reduce your total profit, especially if you trade frequently. Understanding how these fees work helps you calculate your real ROI and trade more efficiently. Also, remember, different cryptocurrencies and different exchanges may charge different rates for maker and taker fees. On the screen, you can see an example of a trading interface showing the fee rate. Maker 0.019% and taker 0.04%. These may look small, but when you trade with large volume or high frequency, they can make a big difference to your final profit. Now let's look at the taker fee. A taker means you are placing a market order. You're taking liquidity from the order book because your order executes instantly. It's just like when you don't want to wait in line, you pay extra for a fast pass to skip the queue. In trading, that extra cost is your taker fee, a small premium you pay for instant execution. Since your trade is filled right away, the exchange usually charges a slightly higher fee. So whenever you buy or sell at the market price, you are paying a taker fee. In short, fast execution comes with a small cost. Next, we have the maker fee. A maker means you are placing a limit order. You're adding liquidity to the order book by waiting for your chosen price. Maker orders usually have a lower fee, and some exchanges even give you a rebate, meaning you earn a small credit for providing liquidity. You'll be charged the maker fee only when your order is matched and filled on the book. So to summarize, taker equals market order fast execution, higher fee. Maker equals limit order, slower execution, lower fee, sometimes a rebate. Knowing the difference helps you choose the right order type and save on trading costs, which is especially important when running strategies like funding-rate arbitrage, where small percentages can decide whether you win or lose. What is an order book? Now let's talk about something you'll see in every trading platform, the order book. The order book is simply a list or a queue of all buy and sell orders waiting to be matched on the exchange. It updates in real time, showing you exactly what prices traders are willing to buy and sell at. Let's break this down. On the right side of the screen, you can see the actual order book. The numbers in green are called bids. These are the prices that traders want to buy at. Each green row shows a price, the quantity being bought, and the total amount. You can think of bids as people lining up saying, I want to buy at this price. The numbers in red are called asks. These are the prices that traders want to sell at. Each red row shows a seller offering to sell a certain quantity at their chosen price. They're basically saying, I'll sell, but only if you pay this much. The market price is the point where the highest bid meets the lowest ask. That's the price where the next trade will happen, where a buyer and seller agree. To make it easier to understand, think of the order book like a queue of people waiting in line. On one side, buyers are lining up offering different prices. On the other side, sellers are lining up too. The exchange matches them whenever a buyer's price meets a seller's price. Now, here's where the maker and taker orders come in. When you place a limit order, you're adding your order to the queue that makes you a maker, because you're adding liquidity to the market. When you place a market order, you're matching with an existing order from the list that makes you a taker, because you're taking liquidity away from the market. So in summary, the order book shows live buy and sell orders. Green bids are buyers waiting to buy. Red asks are sellers waiting to sell. And the market price is where they meet in the middle. Understanding how to read the order book helps you see where demand and supply exist and gives you insight into the market depth, which is key for timing your entries and exits. Why we use maker orders in funding rate arbitrage. In a funding rate arbitrage strategy, we always use maker orders, also known as limit orders. Here's why. When you place a maker order, you're adding liquidity to the market. Your order goes into the order book and waits to be matched. Because you're helping the exchange create liquidity, you get to enjoy lower trading fees, and in some exchanges, you might even receive a small rebate. This is very different from taker orders or market orders, where you execute instantly at the current market price. Taker orders usually come with higher fees since you're taking liquidity out of the market. But in funding rate arbitrage, there's no need to rush. We're not chasing short-term price movements. We're building a neutral position to collect the funding payments over time. So it's much smarter and much more cost efficient to enter and exit our trades using maker orders. To put it simply, maker orders equals lower fees and better profitability. Taker orders equals faster execution but higher cost. And since every small percentage matters in arbitrage, using maker orders helps maximize your net profit from the funding rate while keeping your trading costs as low as possible. Okay, to make sure you fully understand the maker and taker fee, please answer the following questions. Let's start with the first question. Given that the market price of an altcoin is 5.7 USDT and the taker fee is 0.05%, while the maker fee is 0.02%. If you place a market order to short this altcoin, what type of fee will be charged to you? You can pause this video to think about it. Since a market order executes instantly at the current market price, you are taking liquidity from the order book. That means you're skipping the queue, just like buying a fast pass to get in right away. Therefore, the exchange will charge you a taker fee, which is usually slightly higher than the maker fee, because you're paying for speed and instant execution. Let's look at the second question. Given that the market price of an altcoin is 3.2 USDT and the taker fee is 0.05%, while the maker fee is 0.02%, if you place a limit order to long this altcoin at 3.15, what type of fee will be charged to you? You can pause this video to think about it. Because you placed your limit order below the current market price, your order will wait in the order book until the market drops to 3.15 and someone sells to you. That means you're adding liquidity to the market, not taking it. So when your order is finally filled, you'll be charged the maker fee, which is 0.02%, lower than the taker fee, because you helped provide liquidity instead of consuming it. Liquidation fee. Good. Let's talk about liquidation fees. A liquidation fee is charged when your position is force closed due to margin loss. It covers the cost for the exchange to close your trade safely and protect the system from further risk. Typically, the liquidation fee ranges from 0.5% to 2% of your total position value. That might not sound like much, but when using leverage, it can quickly add up. We always want to avoid being liquidated. It badly impacts on our capital. The good news is that liquidation fees are completely avoidable. By setting proper stop loss levels and managing your margin carefully, you can prevent your position from ever reaching the liquidation point. So remember, it's always better to take a small, planned loss with a stop loss order than to get liquidated and lose your entire margin. Here's a real-world example. In this news headline, you can see that over $317 million in crypto positions were wiped out in one single event. Most of those traders were holding short positions, and when the market suddenly surged upward, they got liquidated instantly. This shows how quickly the market can move and how important proper risk management really is. Next, let's talk about how fees affect your profitability. If you're trading frequently, even small fees can add up fast. Always remember to subtract both entry and exit fees when calculating your profit. For example, if the entry fee is 0.05% and the exit fee is another 0.05%, that's 0.1% total per trade. Now imagine making 100 trades in a month. You'd be spending 10% of your total capital just on fees. So even if your trades are profitable, your net gain could be much smaller once fees are accounted for. Let's wrap up with a few key takeaways. Taker fees are fast but more expensive. Only use them when speed truly matters. Maker fees are cheaper and sometimes even offer rebates. So always use limit orders to save costs, especially for funding rate arbitrage strategies. Liquidation fees can be avoided entirely through proper margin control and stop loss placement. And finally, always include all fees in your ROI and risk calculations, because every small percentage counts when you're trading with leverage.